Capital market expectations form the foundation of the portfolio management process because they provide estimates of future risk, return, and correlation for asset classes. These expectations influence strategic asset allocation, tactical asset allocation, security selection, and risk management decisions. Investors develop both long-term expectations for asset classes permitted by the investment policy statement and shorter-term expectations to exploit temporary market opportunities. Effective capital market expectations require consistency across asset classes and investment horizons. Cross-sectional consistency ensures assumptions are compatible across markets, while intertemporal consistency ensures forecasts remain coherent through time. Together, these principles help investors build portfolios aligned with objectives and constraints. The framework for formulating capital market expectations follows a disciplined 7-step process. Analysts first determine which expectations are required based on the investor's asset universe and time horizon. They then examine historical performance and identify the factors that drove returns. Next, an appropriate valuation model is selected, followed by collection of high-quality data. Experience and professional judgment are then applied to interpret current conditions and estimate model inputs. Analysts subsequently formulate expectations for returns, risks, and correlations before continuously monitoring outcomes and refining forecasts. This structured methodology improves decision quality and reduces the likelihood of inconsistent assumptions or poorly supported investment conclusions. Developing capital market forecasts presents significant challenges. Economic and financial data often suffer from reporting lags, revisions, inconsistent definitions, and measurement errors. Historical relationships may break down when structural economic changes occur, making past data less reliable predictors of future outcomes. Analysts must also contend with survivorship bias, data mining, smoothing biases, and uncertainty surrounding model specifications. Furthermore, correlations do not necessarily imply causation, and economic relationships frequently vary across business cycle phases. Forecasting errors can also arise from psychological biases such as anchoring, confirmation bias, overconfidence, status quo bias, prudence bias, and availability bias. Successful forecasters recognize these limitations and account for them systematically. Capital market expectations may be developed using formal tools, surveys, and professional judgment. Formal tools include statistical methods, discounted cash flow models, and risk premium approaches. Statistical techniques utilize historical means, variances, correlations, shrinkage estimators, and time series models. DCF approaches estimate intrinsic value from expected future cash flows and derive required returns. Risk premium models begin with a risk-free rate and add compensation for various sources of risk. Surveys provide insight into consensus expectations from economists and market professionals, while judgment incorporates qualitative information and experience. In practice, sophisticated analysts often combine quantitative outputs with informed judgment to improve forecast quality and adaptability. The topic introduces the trend rate of growth, which represents the sustainable long-term growth path of an economy. This concept serves as a critical anchor for capital market expectations because temporary fluctuations associated with business cycles tend to cancel out over long horizons. Analysts focus on trend growth when developing long-term forecasts for economic activity, corporate earnings, interest rates, and asset returns. Exogenous shocks can alter the trend growth trajectory positively or negatively. Examples include government policy changes, technological innovations, geopolitical developments, natural disasters, resource discoveries, and financial crises. Understanding these influences helps investors assess whether economic growth prospects are improving or deteriorating over time. The trend growth rate can be decomposed into employment growth and productivity growth. Employment growth depends on population expansion and labor force participation rates. Productivity growth is driven by increases in capital per worker and improvements in total factor productivity, often resulting from technological innovation and supportive government policies. Analysts frequently forecast long-term GDP growth by estimating these individual components and summing them. This decomposition provides a transparent framework for understanding the underlying drivers of economic expansion. Because these factors evolve gradually, trend growth tends to be relatively stable in developed economies, while emerging markets may experience more variable growth patterns as they converge toward developed market standards. Economic growth trend analysis plays a direct role in forming capital market expectations. The trend growth rate acts as a long-term anchor for both bond and equity return forecasts, ensuring that valuation assumptions remain economically reasonable. Higher trend growth may support stronger equity returns if growth is not already reflected in market prices. At the same time, stronger growth often increases an economy's capacity to expand before inflation pressures emerge, influencing monetary policy and interest rate expectations. Higher trend growth rates are generally associated with higher government bond yields. Consequently, investors must evaluate how growth trends affect expected returns, discount rates, inflation dynamics, and asset valuations across financial markets. A particularly important application of trend growth analysis is forecasting long-term equity returns. Over extended periods, the aggregate value of equities is closely linked to nominal GDP growth because profit shares and valuation multiples cannot expand indefinitely. As a result, long-run equity capital appreciation tends to track nominal economic growth. Total equity returns then equal capital appreciation plus dividend yield. Analysts often begin their capital market expectations process by estimating real GDP growth, adding expected inflation to derive nominal GDP growth, and then incorporating dividend yields. This framework connects macroeconomic fundamentals with asset valuation and provides a logical foundation for long-term return assumptions used in strategic asset allocation decisions.